You're seeing dramatic changes from week to week in the market's assessment of where the Fed funds rate is going to go. And I've never seen this amount of uncertainty and volatility from a week-to-week basis as to what the Fed's going to do. I think that's a major driver. When volatility picks up, though, then naturally liquidity falls because it's harder to manage risk. And then, of course, that begets more volatility as liquidity falls. So you got a little bit of a trap there.
You're listening to Traders Insight Radio by Interactive Brokers. Find more podcasts and daily market commentary at tradersinsight.news. Please remember, any trading discussions are for information purposes only and are not intended to portray recommendations. Please listen to further disclosures at the end of today's episode. Now, welcome to our show. Let's get started. Hello and welcome to IBKR Traders Insight Radio podcast. I'm Stephen Levine, Senior Market Analyst at Interactive Brokers, and your host for today's program, where we'll be talking with Jason Bloom, Invesco's Head of Fixed Income and Alternative ETF Product Strategy, along with Joe Burke, IBKR's Head of Fixed Income, to help make sense of the recent inflation picture, its impact on rates and the yield curve, as well as its relationship or correlation with economic recessions. Welcome, Jason, Joe. Great to have you here with us.
Yeah, thanks for having us.
Yeah, really excited you're both here. Thanks so much for coming. There's been a great deal of attention in the news media, obviously, and within financial markets, really just everywhere. I mean, among friends, family, everyone seems to be talking about inflation. Yeah, it's for good reason, it seems. I mean, it's certainly concerning. Recent U.S. CPI, the Consumer Price Index, hit an annual rate not seen in more than 40 years. This is driven by higher prices for food, for gas, for used vehicles. Producer prices are also soaring to astronomical heights. I mean, not only in the U.S., but also in Germany. This is Europe's main growth engine. Consumer prices there have also seen a 40-year plus high or 40-year high. So there are a lot of questions here. So I thought we'd just dive right in and ask you, Jason, first, if you could help us understand exactly what is inflation? How did we get here? And, is what we're seeing purely a consequence of, say, decades-long plus accommodative central bank monetary policy and fiscal spending? Or are there other factors at work here?
So, yeah, I mean, at the most basic level, inflation, and obviously there are different ways to calculate it, and people argue over the best way to calculate inflation. But at the end of the day, CPI, for example, the Consumer Price Index that everyone sees in America, is really an attempt to measure, how much does it cost this year versus last year, right, to purchase a basket of goods of the same quality,
yep.
Right? So now, if I am able to buy a laptop this year with double the processing power of a laptop last year, but it costs more, that might not show up as inflation because I'm getting more, right, for each dollar. But at the end of the day, this year versus last year, what does that cost? And this year versus last year, including food and energy, we're looking at last month 8.5% inflation rate. So the same basket of goods costs 8.5% more than it did a year ago, which, as you mentioned, is a high that we haven't seen since the 70s.
Yeah, it's incredible. I mean, and what drives this? I mean, what drives inflation to these levels?
Well, I really don't think that it is the culmination of this decade of easy money that we've had, because really for the first 8 of the last 10 years, the Fed was not actually able to get the inflation that they were wanting to get. Inflation was a little bit lower than what they considered to be a healthy level of inflation. And so really, I think that we flipped economic regimes during the pandemic. When you look at the Federal Reserve stimulus that they injected into the money supply was triple the stimulus we had around the financial crisis, right?
Yeah,
Put this in proportion. Unprecedented. The fiscal stimulus that came from the United States government to try to support the consumer while the economy was forcibly shut down for a few minutes was tremendous on a scale that we've never seen before. And the government kind of ran a little bit wild with that. We got another multi-trillion-dollar stimulus package in 2021 when a lot of people were getting back to work and the consumer was already flush.
Yep.
And that resulted in now, and also to the extent that the pandemic restricted access to services, everyone pivoted their spending to goods, right? So we got all the stimulus coming at the same time that the demand for goods made a gap higher by 20% in a global supply chain that probably couldn't have handled that to begin with. was being hobbled by COVID disruptions, it was a recipe for higher prices. And so, so I would though kind of look at the last couple of years and on the unprecedented intervention by government that is likely the cause of what we're seeing now.
Yeah, it's a great observation. And I think that, we'll come back to that in a bit, because what happens in unprecedented times, I would think, is rather difficult to analyze. But where do you think we're headed with this? I mean, where do you think inflation could be going, in the U.S. or even in Germany? I mean, Germany had inflation levels that were really unseen or through the roof, or, just incredible during, say, days post-World War I in Weimar. I mean, are we headed in that kind of direction?
No, I don't think so. We are seeing headline numbers, right, that are, getting into that territory that we saw during those different periods in time, but they're really happening for very different reasons. And so and even if you look at inflation in the United States, I kind of ran through, what happened during the pandemic that initially jolted inflation to higher levels. And what you're actually seeing now is that goods inflation, as the Fed expected, has actually started to abate. Unfortunately, it's passing the baton to some cost push inflation that's being caused by the commodity price shock to the global economy. A lot of the inflation you're seeing in Germany isn't the result of an overstimulated economy from the demand side. It's cost push inflation from the enormous increase in materials and energy costs that they've seen there. And unfortunately, that looks to be a fairly sticky dynamic given the war in Ukraine and the impact that's having on commodities. Yeah,
I've seen that. I've also seen it attributed to supply constraints because of COVID. And we've heard that a lot. We've heard supply constraints a lot. And I don't know if that's something, it seems to be something that Germany obviously is also contending with and could be a reason for their higher prices of food, for example.
Yeah, I mean, it did start to feel like that excuse was wearing out, but it's true. We just saw another round of lockdowns in China, 40 million people at a time in Shanghai, where they make so many of these goods. It makes sense. Like, the truck drivers can't drive the supplies of the factory. The factories are shutting down, and, that reduces supply and keeps prices higher. So, no, it is a legitimate explanation.
Yep.
And hopefully, we emerge from COVID this year, we see hopefully another variant doesn't make the rounds. But if we do emerge from this, then you would expect in the second half of the year for goods inflation to soften.
To subside a bit. Yeah.
Yeah.
And since you're both in fixed income, I'd love to get your thoughts on how the Fed is combating inflation with monetary policy. I'm sure you have your eyes on what the Fed is doing. Joe, maybe I start with you and what you think the Fed is doing, if it's effective, or you think it will be effective in combating inflation going forward.
Well, interesting question. Thanks, Steve. I think it's clear that they're paring their balance sheet for one, and they're starting to do some rate hikes. It's really unclear as to how many hikes we're going to have. And every day it seems to be a different story. Just a few months ago, we talked about, 25 basis point hikes being the approach that the Fed would take, and it would be very incremental and gradual. And now, 50 basis points is sort of baked in for the next three meetings. And there was talk of a 75 basis point hike, which brings us back to 1994. So, it's unclear how far they will go or need to go. And then I think, they need to balance that with the potential that if they do end up slowing the economy, what does that do to consumer spending? They could, if higher rates lead to a slowdown in the economy, which leads to a quick slowdown in consumer spending, we could be in a world of hurt there with high rates and no growth. So I think it's very much a balancing act at this point, and I don't know. I think the external factors are also at issue. China, to Jason's point, the war in the Ukraine, and hopefully, as was said earlier, hopefully COVID, is gone or will be gone soon, but you never know. And these are all risks to the economy.
Yeah. And for an institution like the Federal Reserve to really need to have a certain level of confidence from those who are putting their trust in the dollar and their ability to rein in stability, rein in inflation. These uncertainties seem to raise a lot of red flags, at least in my view. Jason, what do you think? Do you think that they'll be effective enough at combating inflation? Or are those uncertainties something that you think will ultimately destroy a great deal of confidence?
Well, we used to be talking about tail risks and whether the tails were fat or thin.
Now they're normal.
Yeah, and we are living in a world where the tails are dominating, right? The narrative and the economy and the dynamic. There's no risk, like they're here, and we're living in the tail. And so, to your point, like it's the Fed from a forecasting standpoint is really hobbled. And they've kind of quietly admitted this, and so that's why they're going to be data dependent. Like nobody's trying, everyone has been wrong about forecasting growth and inflation. Now, what's interesting is growth has been a lot stronger, and inflation has been a lot stronger. Like they've been under, right? They've been taking the under and losing on that constantly. Yeah. So, even the numbers today. Now, everyone saw the headline of negative growth on a quarter-over-quarter basis of negative 1.4, but that it wasn't really negative. That was just real growth, right? You took a 6.5% growth rate and applied an 8% inflation rate to it. So nominal growth is actually quite strong. The consumer held up pretty well. Not it's all relative to forecasts. And what's interesting this time around is, we talk about the consumer and there is that concern, right? And there's actually a hope, right? That things slow down a little. You're looking at the consumers just spending like this is like spending like it's 1999 here. Nobody knows what's going to happen. Yeah. Because you're looking at record hotel prices in Florida, right? And then you ask the hotel association about, they're like, it's demand's through the roof. We got 90% occupancy rates. We're charging $1,000 a night for a hotel room that costs $500 a night, in 2019, and people are willing to pay it. Okay, well, for everyone's health and in the inflation, you hope that slows down a little. But I think what it speaks to is that the consumer is still pretty flush right now. And we were talking earlier about the fact that, debt to income ratios are at historic lows. So it's going to be a while before the consumer's like tapped out, and the credit cards are becoming a problem. And then the other thing I'll say, though, that, what was really missing in that 2011 to 2020 decade was capital investment. Corporate capital investment never came back. And, there's a variety of reasons for that. Business confidence was low. We're recovering from the global financial crisis. The government was heaping regulation on business at the same time. But what we've seen over the last 2 years as a result, and in some ways linked to the energy transition, right? Converting to electric vehicles and renewable energy and everything, and that huge infrastructure package that goes along with that, is that capital investment is on a tear right now and shows no sign of rolling over. And that's going to be a new support for growth that we did not see in the last decade, where the consumer was, we're completely dependent on the consumer to keep things going.
Yeah. I mean, as long as I suppose there's return on investment from that capital spending, I think that would be the ideal situation. What I'd hate to see are the fat tails of the fat tails at this point. I think that would be really, really apocalyptic, I suppose. At any rate, and in terms of rates, because we're talking about rates now, so I think the segue of at any rate makes a lot of sense. Joe, how's the yield curve been doing through all of this and through inflation? 10-year's been ticking up ever since it seems the Fed hiked rates in March. But where do you see them going from here? I can imagine that they can only really be going higher. There's also been inversions in the yield curve, 2-year, 10-year. Yeah. We saw 3-month 10-year, I think, in 2019. But love to get your insights as to why this is happening and where you see it going.
Sure. I mean, I look at the twos, tens pretty regularly. And, I think in the 1 year, 1 year ago, we were about 152 positive twos to tens, and then gradually that decreased over time. We dropped below 100 basis points back in November, and from there, it's just continued on down. And just a few weeks ago, we were inverted. I think we got to minus 8 basis points. Which is perfectly normal. You would expect that in a rising interest rate environment or expectations of rising interest rates. So you expect some level of flattening. What I found interesting was the fact that we went from minus 8 to plus 30 in an environment where we went from talking about gradualism to talking about, take out the life jackets because it's, we're going to have to raise rates very aggressively and a number of times over the next few months. So that struck me as a little bit odd. And, additionally, some of these moves, we were talking about this a little bit earlier, some of these price moves, seeing the 2-year note trading, with an 8/32 range in the course of a day, is typically the kind of thing that happens when there's, a major event like a Bear Stearns or Lehman Brothers type of default, or something, some external force that's very dramatic. It's not typical to see that. The 2-year note tends to be a little sleepy, highly correlated to the Fed funds rate or expectations of Fed funds. So, to see it move like that is really troubling, and I don't know how to explain those moves. Perhaps it's a lack of liquidity in the marketplace. Perhaps it could be dealers allocating less balance sheet to the markets and refusing to take positions, which is causing increased volatility. But again, that's conjecture on my part. I don't know. So.
Yeah. What are your thoughts there, Jason?
Yeah, well, I think just maybe take up the baton from Joe's comments there is that you're seeing estimate to the extent that, as Joe mentioned, the 2-year tends to be tied to expectations around the Fed funds rate. You're seeing dramatic changes from week to week in the market's assessment of where the Fed funds rate is going to go. Yeah. I've never, I've only been doing this for 25 years, and I've never seen this amount of uncertainty and volatility from a week to week basis as to what the Fed's going to do. Right. And I think that's a major driver. And when volatility picks up, though, then naturally liquidity falls because it's harder to manage risk. And then, of course, that begets more volatility as liquidity falls. So you got a little bit of a trap there. But it makes sense. It really does make sense. And because going back to the original comments of, the amount of uncertainty as to the path of growth, yep. Inflation, and as a result, interest rates. Incredibly high. Now, I think that when you look at the shape of the curve, what was interesting is we've only had one major round of QT in the last 50 years, and that, wound down in that, sort of 2015 through 2018 timeframe. But what I think the Fed's preferred path is to wind down quantitative easing, stop buying bonds, and then, 3 or 4 months later, even 6 months later, then you start raising interest rates. That was the path in the last cycle. And, or that was the hope in the last cycle, and it worked more. It was very gradual. This time, what you had was the Fed crashing their bond buying program right into the first Fed rate hike. And it was only a few weeks ago that they stopped buying bonds. And so I think what you had was a curve that was, when the Fed's, of course, buying bonds, they're flattening the curve. Yep. So you had a curve going into the first Fed rate hike cycle, and then these accelerating expectations around rate hikes that was a lot flatter than it should have been. And you had every trading house and institution in the world that has a curve view putting a flattener on. And as soon as Lael Brainard came out and said, we might accelerate quantitative tightening, the balance sheet runoff, if we need to slow the economy down, yep. all those curve flatteners started just piling out of those trades, and the curve steepened violently. As Joe mentioned, we went from -8 to actually went to 40 in a couple of weeks. And now we're back here at positive 21 or so. And I think now we're going to start to see a curve that begins to act like a real pricing mechanism, rather than something that's being so distorted and manipulated by the Fed.
Do you think such an approach by Brainard would be effective?
Oh, yeah. To the extent that they want to slow down the housing market, yeah, sure. We're already at 5+ in mortgage rates, and what were we at 3 or 4 months ago? So that will be effective, especially as it relates to housing.
Joe, what do you think the 10-year could go, say, halfway through the year or by year end?
My guess is somewhere in the 3.5 to 4 range. I think we would struggle to get past 4. And what I was alluding to earlier regarding consumer spending is, if these higher rates impede slow down consumer spending, then I don't see it going much past 4 at all. I read this week that one of the economists from Bridgewater was looking for the 10-year to go to 4.5. I think that's aggressive, but you never know.
So let's turn this into a corporate bond story then, with rates going higher like they are. When I was covering corporate bonds, and I was doing this for quite some time as a journalist, I was recognizing that there were a lot of overseas buyers of corporate issuance, that they were either coming from negative interest rate environments or they were just basically on a hunt for yield.
Yeah.
And so in terms of issuance, one, I'm anxious to see whether we're still seeing that effect from overseas buyers today. And two, whether the window for corporate issuance will start to close or become even just very rocky the more volatile rates are as we get closer to year end.
So I like to watch the 10-year Boone yields to see, where is relative value, U.S. versus Europe. Yep. And, what's typical is that I've noticed over the last 7 or 8 years is that the 10-year doesn't like to get much more than 200 basis points above Boone yields. To your point, eventually people just pile in to buy that extra yield over here. And usually the spread is lower than that, but that seems to be where the market doesn't like to stretch much past that. So now Boone yields have gone from 0 to 90 basis points in literally a couple of weeks, a month and a half or so. And that's an incredible move in rate. So if Boone yields continue to move up, as you would expect, as Europe, confronts this, it winds down possibly their asset purchase program later this year, then I think that gives you the leash to go right to where Joe mentioned, go to 4% in the 10-year. Historically, when the 10-year starts to catch up to CPI, it usually does that in a fairly violent fashion. So if by the end of the year we get CPI to 4.5, then that would be consistent with, the three big moves we saw in the 70s and early 80s as real yields tried to get back into positive territory. And to your point, what I've heard is that corporate issuers are eager to call bonds that are callable and roll that debt now, expecting they would have to face higher prices next year.
Yep.
So you would expect issuance to be robust this year if that expectation remains.
I think SIFMA has it as of the end of March, where investment grade issuance has been about 4% higher year over year, while high yield is down almost 70%. I think they're just not taking that risk, or maybe they can't tap the markets at this point, where there might be too much risk and not enough story confidence in the company. Not sure, but a pretty precipitous decline, I would say, year over year in that respect. Do you think that corporate issuers, Joe, are going to find a fast-closing window this year?
It depends on how quickly the Fed funds move up and how quickly the curve steepens. What we've seen is a lot of issuance from the highly leveraged industries, financial services in particular. There's been a lot of debt issuance. I do think that that will continue. Jason's point about calling bonds and issuing them in the new now, it makes a lot of sense. I think that is probably a big driver for what's happening, and it'll. I don't know how short the window is, but I do think that there'll be a lot of appetite to issue debt in the next few months.
Yeah.
Jason, there are those analysts that point to the yield curve inversions as being an indicator of a coming recession. I understand something like 12, 16, 18 months out from the time of the inversion. But do you think this type of analysis, you mentioned an unprecedented environment in terms of fiscal spending. Do you think that this type of analysis, not only because of the fiscal spending, but also because of the unprecedented monetary policy backdrop, do you think that those kinds of analyses about inversions still hold any kind of real substance? Can we really rely on any historical statistics or analyses when we're in that fat tail, as you said?
Yeah, no, I think that, maybe just sort of expanding on the point I made earlier, is that if we get into this environment where the Fed leaves the curve alone, essentially, right, in the market, it becomes a real market-based pricing mechanism, then I think, and if you look, the Fed just sort of republished their research on curve inversions, just I think to kind of remind the market that the real accurate predictor of a recession is the 3-month T-bill versus the 18-month T-bill or note, or Treasury yield, and then a close second is the 3-month T-bill versus the 10-year. And so we didn't see, you mentioned 2s, 10s inverted, but the 3-month and 10 is still pretty steep, as Joe mentioned earlier. And I think that as we get into the later part of this year, with the Fed sort of out of that long end of the curve, if the 10-year 3-month inverts, I'd be looking at that very, as most likely predicting, an impending recession. But
I think there may have been an inversion of that in August of 2019.
And had it not been for the pandemic, there are several strategists who said we were likely headed into a recession.
Wow.
Yeah.
Very, very interesting stuff. So I would like to really understand this a little bit clearer, what the actual relationship is between inflation and recession and how we get from one to the next.
Yeah. So really, inflation is actually, generally speaking, a sign of strength in the economy, generally speaking, right? Especially if it's the result of demand pull. Now, if you get a commodity a disruption to the commodity markets that shock prices higher, and eventually that actually ends up being highly negative for growth. And then you get a Fed who says, look, price stability at the end of the day is the foundation of a healthy economy. We have to arrest these price increases. And if that requires a recession, which Volcker, clearly decided that it did back in the 70s and early 80s, then that's it, right? So high inflation does in some way, portend a recession, but it's more along the lines of what's the Fed going to eventually do to get inflation under control? They might have to trigger a recession to do that. I don't think the Fed has their Volcker hat on yet. I think they're going to go to 2.5 to 3, and they're going to wait and see if that was enough, and we're going to see where growth is. But certainly that risk is high.
I wonder what the 70s or 80s would have been like without Volcker. I guess maybe that's what we'll experience now in a sense. But maybe worse. I don't know. But I don't like to speculate in terms of the future. But it would be great, at least at this point, to get both your insights on hedging strategies. So I'd like to hedge against inflation. What do I do? I mean, do I go into tips? Do I go into certain commodities? Gold? Do I go into cryptocurrencies? I mean, what do I do?
Historically, a broad commodity portfolio has been the most potent inflation hedge in a portfolio. Gold actually doesn't do that well when inflation is hot because usually it's accompanied by rising rates, and gold hates rising rates. So gold does okay, but the beta to inflation, like for every 100 bips increase, in 1% increase in CPI, gold goes up like 2%. Commodities, on the other hand, broad commodities portfolio, for every 1% increase in CPI, historically, they go up 12%. So they're 6 times more potent than gold. Tips are better than regular treasuries, but the vol is so low in their bonds with duration, which doesn't like rising rates. And you need to have something like 60% tips in your portfolio to be fully hedged against inflation. So broad commodities, real estate does quite well. The beta there is about 6. So not as good as commodities, but kind of the next best thing. Equities are around 3. So equities, they're okay, not a great inflation. Commodities historically have been the most potent inflation hedge.
Well, we've raised a lot of concerns as well about the confidence in the Fed. And so I suppose that translates also into confidence in the dollar or fiat currencies, whether or not that trust remains there, or will the currency become devalued to the extent that we saw in certain countries where there's been excessive monetary accommodation, like in Zimbabwe or Weimar Germany, where we saw catastrophes in currency. And so if that sentiment is there, and I think a lot of motivation to go into cryptocurrencies is to move away from what they may consider as being too much of a risk in terms of their own country's fiat currencies, which is a very scary prospect, but it seems to be going in that direction.
Yeah, looking at currencies, the dollar index up almost 8% this year. Even the trade weighted dollar is up almost 4%. That's becoming a large concern for me around growth globally. There's a very, very strong relationship between the U.S. dollar and emerging market equity earnings and emerging market equity performance. This is really bad for EM, for the dollar to be on a tear like this. And then, people are starting to you're starting to hear a little more conversation about the dramatic fall in the Japanese yen. And the Japanese Central Bank, Bank of Japan, coming out this morning and kind of surprising people, saying, we are only committed to keeping interest rates low. They're taking no action overtly in the markets to stem the decline in the yen. And, to the extent that currency, if it were to collapse, that could be very, very bad for Japan and then for the world, because that'll have massive ripple effects, because the Japanese have been one of the biggest buyers of U.S. Treasuries over the last couple of years. So if they sell Treasuries to bring that home to support the yen,
we're seeing a massive devaluation of the U.S. government Treasuries. Yeah.
Yep.
So in terms of outlook, and we've discussed outlook, but broadly speaking, in terms of inflation, and this was our main focus of concern, where do you see it going? Where do you see us going? And does it plateau? Does it end at some point? What do you think? What's your let's say your worst case scenario and your best case scenarios? Joe, maybe we'll start with you.
Yeah, I think the worst case scenario is that the Fed loses its willingness to raise rates enough to control inflation, and because it's not supposed to be political, but there is a political component to it, right? They don't want to put the country into a recession and cause pain and suffering, right? That's a big part of it. But if they don't have the will to raise rates aggressively and to a level where they do beat inflation, then I think we're in for a lot of problems. I think we won't, if we lose the battle with price stability, I think we just have many, many more problems. I don't know where that goes. So I don't know that that's happened before, where we've had this, spiraling inflation and an unwillingness to control it. But, between the size of the deficit, the amount of debt we have outstanding, these rate hikes are expensive for the government and ultimately the taxpayers. So I don't know where that goes. So if we can't get that done and we can't raise rates sufficiently, that I see that as a big problem.
That sounds like a runaway freight train is what that sounds like.
It could be.
Yeah. Jason, what do you think?
I think that's a real risk. That's a real risk. Our expectation is, especially over the next 6 months with crude oil leveling off around $100 a barrel here, that we will see inflation peak. I think that 8.5 print could be the top. We'll see. Or the next CPI, either that one or the next, I think will be the top, and we will see that headline number coming down. But there's a lot of momentum in the inflation dynamic right now. We're starting to see a few cracks in the surveys of employers who are a little more reluctant to continue the wage spiral. And so the hope here is that if we get the labor force participation rate coming up, there's still a couple million people that are out of the workforce. Hopefully we get some more of them back. Yep. Again, we get wages softening. The consumer kind of wears themselves out here with their vacation spending over the next few months. The hope is this all comes back to earth somewhat, but not, but I still think that, I would take the over. If the forecast is 3% CPI by December, I'd be surprised if we get to that with the way commodity prices are going to go. And by the way, look for higher crude prices in the second half of the year after the SPR release has been spent. And Russia production continues to decline. And that will then again sort of preserve that higher level of inflation. If we can get it to trend at 4% rather than 8%, maybe everybody will be okay with that. But we got a lot of work to do before we get there.
Well, let's hope for the best, I suppose.
Yeah.
At the end of the day, it's been really great. Well, this is a really, really great conversation. Both of you, Jason, Joe, thank you so much for taking the time to do this. It's really great, and I hope you'll be back with us.
Love to. Yeah. Thanks for having us, Stephen.
That'd be awesome. Thank you so much. And listeners can learn a lot more about inflation and rates in our daily market briefings at tradersinsight.news. There you'll also find a lot of great commentary from Invesco, as well as through our webinars at IBKRwebinars.com and more educational courses at tradersacademy.online. And until next time, I'm Stephen Levine. with Interactive Brokers. Thanks for listening to Traders Insight Radio. As always, there's more content at tradersinsight.news. And if you're interested in learning more about Interactive Brokers, visit IBKR.com. We offer more trading education materials such as webinars at IBKRwebinars.com, market-related courses at tradersacademy.online, and quant-related articles at IBKRquant.com. Futures are not suitable for all investors. The amount you may lose may be greater than your initial investment. Before trading futures, please read the CFTC risk disclosure. A copy and additional information are available at IBKR.com. There's a substantial risk of loss in foreign exchange trading. The settlement date of foreign exchange trades can vary due to time zone differences and bank holidays. The interest rate on borrowed funds must be considered when computing the cost of trades across multiple markets. Trading in digital assets, including cryptocurrencies, is especially risky and is only for individuals with a high risk tolerance and the financial ability to sustain losses. Eligibility to trade in digital asset products may vary based on jurisdiction. Interactive Brokers is not affiliated with and does not endorse or recommend any third-party investment information, advice, services, or products discussed in this episode. The analysis in this material is provided for information only and is not and should not be construed as an offer to sell or the solicitation of an offer to buy any security. To the extent that this material discusses general market activity, industry, or sector trends, or other broad-based economic or political conditions, it should not be construed as research or investment advice. To the extent that it includes references to specific securities, commodities, currencies, or other instruments, those references do not constitute a recommendation by IBKR to buy, sell, or hold such investments. The material does not and is not intended to take into account the particular financial conditions, investment objectives, or requirements of individual customers. Before acting on this material, you should consider whether it is suitable for your particular circumstances and, if necessary, seek professional advice.